Welcome to the daily update. This is being prepared Wednesday, July 6th, where we'll look at the action in the market today and then see how things look for Thursday, July 7th. And that positive buildup that we've been seeing, it's still continuing, although it's pretty subtle. You have to really look under the hood to find it. We're not seeing it yet with follow through in price, but we're seeing a little bit of strength and a little bit of improvement starting to build up. Now we want to say, is that going to continue? Is that going to eventually follow through into price and take the S&P back higher? Or is it going to go away? Because we've had a lot of positive setups in 2022 that we were watching suddenly disappear. Is this going to be what happens to that? So we want to keep an eye on both sides as we wait for price to confirm if we're in fact going to go higher. So let's go back and talk about Wednesday. At the open, it was pretty flat. And when you have a Fed day or an FOMC day, which now when the meeting minutes are released, that's what it's become, especially when we're in the environment that we're in right now. A year or two ago, when the meeting minutes would come out, the market didn't even pay attention to that. Well, now they really pay attention to it, just as we go through different changes in the economy. But we had a pretty flat open. And then after the initial gyration that usually can happen at the open, prices then drifted a little bit lower, not decidedly negative, but they did drift lower. And then as the day went on, after the prices were falling, it quieted down. And then we had an upward bias, which is pretty much what we see when there's Fed days in the mix. You'll have a slight upward bias and a pretty quiet market. Then the meeting minutes were released at 2 p.m. Eastern, and we had some initial gyration, not as much as what we usually see, but people went through and read it and said, okay, we're not really seeing anything new here. So there's really nothing to react to. That took things a little bit more positive, and we ended up pushing higher above R1, which was at 38.62. And then we did see some late day selling. That took a lot of the gains away, but it remained slightly positive going into the close. And we were up 0.36. So yeah, a little over 1/3%, not a big deal, but this is kind of what we're seeing right now. Very small gains, but under the surface, the technical picture might be improving. Volume was below average, which can be pretty much expected now. And the technicals, they're switching back. They're looking a little better. We're still negative. We're still below the moving averages. We still have a lot of headwinds to face as far as economically, and sentiment is still decidedly negative, which again is still extreme, but it's not capitulation extreme. The markets, of course, the real fixation continues to be what it's been, inflation and interest rates. We have the whole list of geopolitical concerns, earnings as they are released, and then the recession fears. And that's most of what you're hearing about right now. Are we in a recession right now? Are we going to go into a recession? What's that going to mean? How are things going to be adjusted? And it's going back and forth. And so you have a lot of indecisiveness right now. So the rotation scenario is still holding up. We're seeing a still small improvement, and I'll show you the charts of that. The S&P was able to regain the 20-period moving averages. Yeah, I get to show you a couple of moving average charts. We don't get to see those much in 2022. Oil continues to fall, not as much as it did yesterday, but it's still falling. And the 10 to the 2 and the 10 to the 5 yield curves have now gone inverted. The 10 to the 2 is probably the more important one. That's the one that people tend to really pay attention to. So that's signaling that there could be a recession. Now, it's one of those things where just because it signals doesn't automatically mean there will be a recession, but every time there's been a recession, this signal has been generated. So it's kind of back and forth. Fear is still really extreme, and I'll show you that. We had the weekly MBA mortgage application index come out, and it was down 5.4%. And the IHS market services, the final reading was 52.7, not a real biggie, The big one was the ISM non-manufacturing index. And that came in actually a little stronger than expected. It came in at 55.3. They expected it to be at 54.2. The JOLTS job opening still shows a really high number of jobs that are available, over 11.25 million that are available. Our trend is negative and weakening because as we have these slight up days, the last trend that the ADX picked up was a downtrend. So as we tick a little bit higher, the ADX gets a little bit weaker. The bias is still mixed. Yeah, we're kind of with a positive slant, but there's really no conviction behind this. These little less than 1% gains are not really helping us to look more positive. Our momentum, I've actually switched a little bit more. Instead of being just negative, I've switched it more to mixed. And as I go through the charts, you'll see how some things have switched a little bit. So let's go back, first look at sentiment. We're still at the same reading that I had for yesterday's video. Still extreme, not really freak out mode, but people are not really all that excited about the stock market right now. And here shows how we're kind of drifting sideways right about at the 25 level. Here's one of the Isabel net charts where really, if you just look at this whole chart all together, you see where most of these diamonds and dots and things show up. That's what we're trying to show here, is that if we're in a risk off position, that means people are not into stocks. They're mostly into bonds and more risk-free or risk less type of investments. Then you'll see most of these dots come up over on the left. If we're more in risky investments, which produce greater returns, but have higher risk attached to them, you'll see more dots over on the right. And that's really what we're seeing now, is most dots are on the left. They're more in a risk off type of scenario right now. Then this next chart shows the 10-year US Treasury yield. And that's the dark blue line, which has been going up and then lately has been coming back. And then the lighter blue line are the cyclicals or defensives. These are the value plays. This is what people get into when the market starts going down or when the economy starts getting weaker. And they tend to move hand in hand with each other. Not a direct correlation, but a pretty strong one nonetheless. We'll see how they're kind of decoupling from each other. They're getting kind of far away right now. Now, you could have said that at other times as well, but we're in a little different environment now than we were back at other times when these lines got kind of far apart. So that's just showing how things might be changing in the economy. We also have the PMI that came out, the manufacturing PMI, that came out last week, and it's really been decreasing. It's the yellow line, and this shows the year-over-year change in the S&P 500, which has also been declining. And this is PMI of 50 for July, and that's about they're predicting about a 3,700 level in the S&P. And then if they go with what they forecasted, they think the PMI might decline to 43, which would then bring the S&P potentially down to about 3,000. Just a forecast. Then, and I love all these look backs and what's going on. This is the annual returns. And right now, it looks like we're having the worst year since 1872. And I think last week I did a video, it's the worst year since 1743 or something strange. And then bonds are the worst since 1865. So it just shows historically how, yeah, the S&P has been having a lot of trouble, but the year isn't over yet. These years that we've been looking at in the rearview mirror, those are total years where we still have part of the year left to go. Now, it could still get worse, but on a historical basis, we're about as bad as what it has been in the past. And we're only halfway through the year. If we can bounce back and start to go up, then this will wear off of this extreme reading. Then here's the ISM manufacturing. Again, that's the one that came out last week. We had the non-manufacturing that came out today. And it just shows the purple line has been really declining as the S&P has been declining. And oh, I'm sorry, this is the Goldman Sachs cyclicals and defensive. It kind of looks like the S&P itself, but it just shows they're both in a downtrend and they're kind of far from each other now, where they tend to kind of hang out closer together. Then this shows bond volatility. The bond market's just been getting crushed in 2022. And this is like the VIX on the bond market. It just shows how it's been gyrating all over the place and how bonds have really become very volatile. The last time we saw this was during the COVID plunge. So things are pretty crazy in the bond market as well. Then here's the risky against safe assets in the fund flows. When we're below this line, this kind of purpley line, here's this little orange diamond here. It just shows that we're more in safe assets. If we're above this line, people are getting more into risky assets, which means stocks. And in this crazy looking chart, this is trying to look into the future and saying, okay, this is where we're at right now. These are what we think the returns will be in the future, which are quite a bit less than what we've been seeing up to this point, at least up until the beginning of 2022. So they're just not looking at really strong returns in the future. Then this is also showing the midterm returns after 2 consecutive negative quarters going all the way back to 1925. What have the returns been like? We've had 2 negative quarters in the stock market, the first quarter and the second quarter. What are the returns for the last 2 quarters? And it just shows that we've had an average of being down 15.61%. Now you can take these same numbers and twist them around and make them say something kind of different, because there's other studies that I've showed you where it talks about how great things have been going forward when another set of conditions end up happening. So that's what we have to be aware of. That's why I show lots of different things, and I don't really put a lot of weight into these studies, because you can, I used to be a math teacher. I know how to manipulate the same data to make it positive and negative, where you're using the same numbers. You can make a case for either side. I'm not saying that's what's going on here, but we have to be aware of that and come to the point where we make our own decision on what's going to happen going forward. Then the first quarter forward return, the average was about 3.14. We also have the mean coming down here, which was positive. And then the second quarter forward return, third quarter, fourth quarter, blah, 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 blah. All these different numbers here, just showing that it doesn't necessarily look all that positive going forward based on these numbers. But there's other numbers we've looked at that look very positive. All right, let's look at the VIX. It declined a little bit since we had a slightly up day, both on a closing basis and we closed near the lower end of the bar. And the VIX of the VIX continues to drop. It just means that the volatility of the volatility index is continuing to drop right now. The Ulcer index, it ticked up slightly, but it's still showing that fear, according to this indicator, is not very high right now. We're down 20.20% since the all-time high. And the equity put call ratio on the daily chart, it ticked up slightly. The 5-period just was pretty much flat. Support and resistance, again, these charts kind of take them as you might see them helpful to you. Here are the resistance and support levels, the pivot levels for Thursday's session. And here's the daily chart. And I wanted to point out here how we went just a little above the pivot and then closed right below the pivot. So this is still overhead resistance that we have to deal with. And volume continues to be below average. Here's our machine gun chart where we're still dealing with this overhead resistance, not only in the pivots, but also resistance that we've seen not too far in the past. And here's another look at this same chart right here, where we actually broke a little bit above this long-term resistance, which had been support. Can we continue to go higher than that? And here are the standard pivot points for the month of July and the DeMark and the Fibonacci pivot points. This is kind of the same chart that I was just showing a little while ago. We're just a little bit above these 2 fib retracement levels. That could be positive, but we need to see more follow through action. See how we're just going up a little, down a little, up a little. We're just bouncing around right now. And we're still above this 38.2% retracement on the weekly chart with the 50% Fibonacci retracement. And then the 200 week is this blue line coming up here. We're still well above that, at least for right now. The sectors, the ones that did the best are utilities. Tech was up okay. Healthcare, not real gangbusters. The one that was down was energy. And that's the best performing sector so far of the year. Here's the Scooter report showing the utilities, energy, and healthcare and staples are in the 90s as far as their technical analysis rating. And we have the usual communication and discretionary, which they're not in single digits, which is where they were. So they are improving, but they're still not very healthy charts. And here just shows how energy, which it's just kind of ticking down here. Utilities were up slightly, so they're back positive a little bit, but all the rest of the sectors are negative since the all-time high. We had our alerts. We had the S&P, which dropped below 30 on the BPI chart yesterday. It came back above today. And that's really the only one where you got the dollar just screaming to new highs right now. Here's our intraday chart, pretty much a flat open. We bounced around at the open as usual, had a negative bias for the first part of the day. Once we kind of finished doing that, we started going back with the positive bias. Then here's where the meeting minutes were released. So the market gyrated a little bit, shot up higher, got above R1 slightly, but then came back down below it and gave up a lot of the gains that we saw during the session. Our trend is showing that the ADX is still below the moving average and the ADX is declining slightly, but it's still above 20. Breadth showing pretty much flat based on price and flat based on volume. Our advanced decline ratio is slightly negative. And this is kind of encouraging. We're seeing a little bit of a turnaround with the new highs and new lows, where it was starting to roll over with the 5 period. And it could have been starting to roll over with the 10. Well, we had a pretty positive reading today. And so this has turned these moving averages back up slightly. Accumulation distribution also advanced slightly, and we're still moving slightly away from the moving average. Short term, here's a moving average chart. We're back up into this 20 period land. We actually closed above the simple moving average, but we still have the exponential moving average. That's the blue one, still above current prices. And here's our moving average tree that I haven't shown in a long time. And just showing how all the other moving averages are well above where we're at right now. Here's our rainbow. We're trying to come up into the other side of the rainbow. We actually hit one of these moving averages because that's a 10 and a 20. So these are shorter term. So we hit those faster. The Stochh RSI, haven't showed this one. We're starting to get extreme positive, which is kind of strange because the market really hasn't done all that much. After giving an extreme negative reading, we shot up, came back down, coming back up. But I am not sure why this is so sensitive right now. Williams percent R is behaving a little better. It's positive and above 50, but not extreme right now. The force index was up slightly. Swinland trading oscillator. This could be positive too. We're finally starting to see this turn up slightly, both based on price and volume. And sometimes, not always, but sometimes this indicator has helped lead the way for what will happen. The McClellan oscillator also ticked back up and is above 0. We had a little tick up with the 20, 50, and 200. Actually, the 200 was flat to slightly down in our moving average study. Stochastic looking okay with the short and intermediate term. We're still rolling over with the longer term stochastic. Intermediate term, haven't shown this in a while. This is the anchored moving average going back to the COVID low on March 23rd, 2020. We closed just a little bit above that right now. Can we hold above that? The PMO, positive overall, positive based on price, still negative based on volume, but trying to look a little better. Our PMO studies show a bit of an increase with the PMOs that are rising, those that are giving buy signals, and those that are above zero. Chaikin oscillator still holding up and looking positive. Chaikin money flow, however, still pretty much flat, but showing a little bit of improvement. We have a slight green bar that's forming here. Volume continues to drop off as we are below average in volume. This is positive too. The vortex is cross positive, but below zero. So the green line is now on top of the red line. Summation index also looking positive based on price and slightly positive based on volume. All of our oscillators have now switched over positive. And that should give us more of a positive backdrop for our overall stance on is the S&P positive or negative. When you have all of these oscillators crossing positive, that is positive. The bullish percent index, where it dropped below 30, came back above it in today's session. The ease of movement is going above zero and still looking okay. Ultimate oscillator is still going down. Haven't shown this in a while, so I just want to bring this one up. The rate of change, we're coming out of an extreme negative reading. The TTM squeeze is still showing improvement right here. These bars, these faded red bars, they're getting smaller and smaller. So that's just showing we're getting closer and closer to zero. Now, I do have some different charts to show. The Heiken Ashi is looking more positive with an open candle. The Kegi chart has stayed positive. We still have black lines on here. The Renko drew in a new open box. So that's new and that's positive. Our different trading systems, the Elder switched to positive for the S&P and for the SPY, and the SAR continues positive. So you see, there's a lot of positive things happening here. We're just not seeing it with follow through in price, and there's an awful lot of negative headwinds that the market has to go through. This is also positive. The go no go system has switched back to a pale purple instead of the dark deep purple that we've been seeing for a while. So it's more neutral with a negative slant to it, but it is improving. Long term, had a little tick up with the 50, didn't really change much with the 150 or the 200. I haven't shown this in a while. We're still staying above this dashed line, which is the midpoint in this trend channel that we have here. And the special K continues to decline, and it takes a lot for that thing to move. The Dow, I wanted to show this because we came right up to the pivot and that acted as resistance and we fell back down. The Dow was up a little less than 0.25%. And I have to clear my throat. The Wilshire also came right up to this pivot level and came back down. The diamonds have switched back to positive, and the Qs have stayed positive, and the Vixen is showing a decline on a closing basis with the line, and we closed right near the end of the bar, or the low end of the bar with the Vixen. The NASDAQ is slightly above the pivot level. Are we going to get some leadership from the NASDAQ? So far, they're kind of in the lead as far as looking at pivot levels. And so that's the growth area. That's what could really help our rotation scenarios if we see follow through from the NASDAQ. And also the NASDAQ 100 is also slightly above the pivot level. Looking at the broad market, the CRB was down another 0.75%, still in an overall uptrend, but showing a lot of recent weakness. The dollar's just screaming to the moon, closed at 106.90. It's almost up at 107 with this. Here's the euro, which has really been falling down. It's at 101.83 with the dollar at 106. Man, these charts are hard to read. Okay, we'll just go on to the next one, showing how the Japanese yen has declined as the euro has declined and the dollar has. And again, this doesn't mean the dollar is all that wonderful and all that great. All three of these currencies are fiat currencies. They're not backed by anything. It's just what people think of them. And Japan's having some trouble. They're having some trouble in Europe. And it just means, okay, what are we going to do? We have to get into some kind of currency. Let's go into the dollar. It's the least crappy right now. So the dollar may have its day when it really goes down the toilet, but it's not today. Here's the S&P to the dollar, pretty much neutral right now in their how they move with each other. Oil fell a little bit more, almost 1%, down to 98.53. Here's the correlation between the S&P and oil, also pretty much neutral right now. Copper bounced up a little bit here, but still has been in a pretty solid decline. Here's just showing a little bit of a bounce, but how the copper to gold ratio, because gold's been having trouble now too. So it's like, which one is doing the least bad these days? And here's that same chart. Here's the black line here where we bounced up a little bit. And here's the 2-year yield, which is coming back down. So these lines are coming back a little bit closer, but they're still very far apart from each other. Gold was down another 1.5% on the futures contract and down 1.58% on the ETF. And here we're seeing a death cross right now. And here's the longer term chart of the gold ETF. Silver was down also. It looks like this bar could have been slightly up, but it closed off of the highs of that bar. And we were down 0.25%. And here's the longer term look at silver. And that's what's mystifying, folks, because in this kind of an environment, you should see precious metals doing better, but they're just not. So then people go, well, what about crypto? It should do better. It's not. So it's like, what do we do? The dollar is the only thing that's really holding up right now. All right, here's the S&P to the 10-year, also back to neutral. It's like we're getting ready to reset or something here. And the tech to the 10-year correlation, slightly in the same direction, but kind of hanging out closer to the neutral area. This is what I wanted to show with all of our different yields, where we have the 10 to the 2, it's now gone inverted, and I have another chart to show you that. The 10 to the 3-month is still holding up. That's what some people use. The 30 to the 5 years also holding up. The 10 to the 5 is inverted, and 10 to the Fed funds rate, it's also holding up. So we have part of the yield curve doing okay. The other part is starting to invert. And here's the 10 to the 5, which we've been watching this for quite a while now. Here's the standard yield curve that most people use, and the 10 to the 2, and we have gone slightly inverted now. And we saw the more mature yields go up in the lengthier maturities today, and we're pretty much flat with the shorter maturities, and that has caused things to go slightly inverted. Our possible positive scenarios, the Copic curve is still giving us a signal, showing us that something may happen. We're not exactly sure what way it will go, but this, we now have a signal with the Pring bottom fisher. So this is something to put on our radar now, and this is directional. So it's suggesting that we might see some kind of a move to the upside from here. Here's our rotation, sector rotation charts. We poked up a little bit with the Qs. Discretionary was flat to slightly down, and the growth to value is still showing some advancing here. So this is still looking okay. And then looking at the growth to value with the large caps, it was up, mid caps up, and kind of flat. Small caps are getting hammered right now. It'd be nice if they were behaving a little bit better. That could feed into this scenario, but we're just not seeing that right now. Here is the 2-year treasury spike, which we've been coming back down with the 2-year yield. Is that going to mark some kind of at least a short-term bottom in the S&P? And here's the correlation between the S&P and the 2-year yield. Again, things are going back to neutral right now. It's like they're getting ready to reset somehow. The staple sector, it was up 0.29%, but we're in danger of seeing a death cross here if things continue, if these prices continue below the moving averages. And here is our new spike that we're now watching. It's coming back down ever so slightly, but we don't really know yet. Is this a real spike? This one we thought was real for quite a while, only to have it come back and be taken out. So what's our outlook then for Thursday? We're seeing improvement with the technicals. Sentiment is still extreme negative. We have the jobless claims and trade balance. None of these, or either of these, are really that big of a deal unless they're really crazy and just cause the market to freak out in one way or another and do what it already wants to do. And then we have the whole geopolitical list of Russia, Ukraine, China, the supply chain, inflation, interest rates, margin calls if we keep dropping, oil, which has been falling. Is it going to continue to fall? Earnings as they're released. We don't really have any Fed speak, at least officially. Right now, it might be a speech or an interview that somebody gives, especially what Chairman Powell says. And then Japan with the situation that I kind of explained a little bit in yesterday's video, and then the recession fears. That's the big thing right now. So what can keep us going down here? All the things that I just said, because these are some pretty strong resistance areas to the market right now. But our technicals are showing improvement. You see, we're seeing a lot of things switching over positive. We're just not seeing a lot of follow through with price. So what can help us go up from here? We are seeing a real improvement and a disbelief that the market is not going to go higher. And our possible positive scenarios are they're holding up for right now. We'd like to see some more of those kick into gear, but they're just not happening, at least yet. And the technicals, we got back above the moving average, at least the 20 period moving average. Can we go back and maybe get to the 50? Seems like a dream right now, but stranger things have happened. And we look at the pivot points, the fib retracements, and then previous highs and lows to provide either support or resistance. We're not really sideways because we're still above 20, but the ADX is weakening. So if you're more aggressive, you might look at doing some sideways type strategies. So our conclusion then is the S&P is negative, but our oscillators are positive, and we're seeing some of our indicators switching over to positive. Short term, negative, but could be improving, as well as intermediate term. But long term, we're still negative. And I pretty much base that on if we're above or below the 200 simple moving average. And we've been below that for a long time. So thank you. Have a very good Thursday. I'll plan on preparing Friday's session, especially if something crazy happens in Thursday's session. We have the employment situation report coming out on Friday. So I might do a video just to get everything geared up for that. So have a wonderful Thursday, and I'll talk to you in the next video.